You know, over the last couple of months, we've seen new highs and big gains in the markets. But just as we see in down markets, up markets can create some anxiety as well. So should you stay the course as the markets beat records, or is it time to get out and sell? Stuart Smith with ML&R Wealth Management here to help us through this really good time with the stock market.
But stressful, right?
It can be stressful. You're right. We were just talking off camera about how you get excited when you start to see things do well, and you want, do I get more? Do I sell? You know, it's a different kind of stress. It's a
balancing act, right?
It is.
Yes.
All right, so your tips begin with this, which is the great one. Ignore market predictions.
Yeah. So everybody on Wall Street has an opinion about what's going to happen today, this month, and this year. And the funny thing is you can find the exact opposite of what somebody says. Somebody else is going to say different. So what you need to do is ignore those predictions, because really this is a long-term look at what you're going to do, and they're going to predict something on the short term. You don't want to pay attention to that. You just want to leave your investments and let it do what they need to do.
And it's kind of like opinion pieces in the newspaper. You have to have one. You have to have an opinion on what's going to happen in order to get paid to do their job. So it's hard to know.
That's exactly right.
Exactly. What to watch. All right, This is tip number 2. Sell winners, buy losers. Explain this one.
Okay, so we have a balance between stocks and bonds in our portfolio, and one of those is going to go higher or lower over time. So right now stocks are going up. So you should have a target allocation to how much you want in stocks. And if you're above that target, it's a great time to sell those winners, take them off the table, move them to bonds. When we go the other way, when bonds get higher, then the allocation takes some of those bonds and put it into stocks when they're down. We tend to do the opposite because that's how we feel, but that's really the better way to do it, because you're selling high, buying low.
That's a great tip for somebody like me that doesn't know anything about the markets to really remember. Okay, you say don't go to cash in a panic. What does this mean?
Well, there's a lot of political unrest right now. There's a lot of uncertainty around what's going to happen with Trump's administration, and everybody's really worried, especially about regulations. And so what that does is it creates anxiety. And when you have anxiety, people want to get out of the market. The problem is if you get out today and the market goes up and you get in, you've missed that run up. If you get out today and the market goes down, then you have anxiety that's gone down. When are you ever going to want to put it back in? So what you need to do is, again, think about it as long term. Don't move to cash unless you need it for short-term goals or cash reserve on hand. That's the only time you need cash.
Stay the course. Manage your risk.
Okay.
This is a hard one. This is a tricky one.
I mean, we were talking about Yvonne, and really thinking about where are you right now in your life, right? How much risk can you afford to take, right? If you're younger, you can probably afford to have more equities in your portfolio, so that percentage can go up, maybe 70%. If you're closer to retirement, that needs to come down, because you don't have the opportunity and the time to lose that investments if the market moves. So you need to think about what risk you can tolerate and make sure your portfolio is balanced and kind of accounting for that risk.
And it's all about where you are in life, too. Yeah. You're exactly right there. Okay, adopt a long-term point of view.
Well, it goes back to that day-to-day reaction to what stocks are doing. You have long-term goals, and your portfolio is built around those long-term goals and what they're going to do for you. There's going to be lots of movement in the short term. You have to ignore that, because if you don't need the money for 5 years, 10 years, 20 years, then it doesn't matter what it's doing right now. Just leave it and forget it and think long-term. Don't think in the short term.
It's like that appliance. Set it and forget it.
Exactly.
That's what you should do with your portfolio. Exactly. Stuart, as always, great ideas from you once again to keep our money safe and help us all get rich someday.
Well, that's what we hope for.
Great to have you here.
Good to see you.